Friends, I, Captain Vivek Jain, welcome you all to my 15th episode. In my earlier episodes, we have discussed and learned about important parameters of the financial ratios of a company, along with the parameters of the balance sheet and the profit and loss account. Friends, let us clearly understand that with the study of above three types of financial information, we can very well judge the strengths and weaknesses of any company. And that is what is known as the fundamental analysis. Friends, in the previous episode, we have also seen the actual figures of the financial ratios of few good companies, and we have explained those. In continuation, today we shall see and understand the actual figures of the balance sheet of few blue chip companies. Just to remind you once again, what is a balance sheet? A balance sheet is a statement of the financial position of a business that lists the assets, liabilities, and owner's equity at a particular point in time or day. It is called a balance sheet because at any given moment, each side of the equation must balance out. Assets means what the company owns. Liabilities means what the company owes to others. Friends, we shall start with the balance sheet of a leading pharma company, which you can see on the screen, Dr. Reddys Laboratories Limited. I have the balance sheet for past 5 years from 31st March 2016 ending till 31st March 2020. Balance sheet is described with the figures as on a certain date. So these 5 columns that you see, they are the relevant figures for the period ending 31st March of each financial year. You can see that the equity share capital of Dr. Reddys Laboratories is 83 crores, which has been all along, more or less, between March 16 and March 20. Reserves and surplus, which are accumulated profits which have been plowed back over so many years, is in a substantial figure. And with reserves and surplus added to equity share capital, it is called total shareholders funds. This shareholders fund is also actually a part of liability because this has already been spent, invested, and given to the company. Then the remaining part of the liabilities starts with non-current liabilities, in which you have long-term borrowings, deferred tax liabilities, other long-term liabilities, and any long-term provisions. These are totaling in the latest 31st March 2020 as 412 crores, started with 1467. Then in between, in the year 2018 and 19, the company probably had to resort to some long-term borrowing for some working capital need of many other needs. And then subsequently, with the profits of the company, those loans were reduced. And on 31st March 2020, it is only 130 crores. Short-term borrowings are actually for working capital and for very short-term usage. This is also in a very medium mode, 2272, and ends with 1653. If you add both the borrowings, short-term and long-term, in the latest year it comes to around 1783, started off with 32 or 3300, and if this is compared with the total shareholders fund, that is what gives us debt equity ratio. And a debt equity ratio of less than 0.5 is considered to be very acceptable and very good for the company not to resort to very high borrowing. A 0.5 debt equity ratio would mean that Dr. Reddy could have borrowed 6,000 crores in March 16 and nearly 7,500 crores in March 20. But the company has not taken that much loan. It is only 1783 as per the latest 2020 figures. Then we have trade payables, which are for sundry creditors, other current liabilities which the company may be having. The details can be seen in the AGM report, where the details of every figure is also provided over there. Short-term provisions for any expenses that the company may be foreseeing in the next 6 months or 9 months are also given here. And the total current liabilities falls 7214. This, when added with total shareholders funds, becomes 23,225, which is the liability as on 31st March 2020. Now we come to assets. Assets are also divided in three sections. One is non-current assets, which has got tangible assets. Tangible assets would mean all the fixed expenses which the company has made over the years, and these are assets which are needed for running the show of the company. Then you also have intangible assets. In some companies it is very less, in some company it may be higher. In Dr. Reddy it is about much lesser than tangible assets, of course, but still quite substantial. And these intangible assets are something which you cannot really touch or feel. It is notional figure actually, and it comprises of the intelligence which has been bought by the company, or some patent which has been lodged by the company, or some kind of a purchase of some formulas which had been paid by the company. So these comes under intangible assets. Capital work in progress, in case some kind of a work for the development of the company is going on, for that the figures are also shown here. The second portion is fixed asset portion, in which you have non-current investments, deferred tax assets, long-term loans and advances, which is nil. Company has not given loan to anyone, and other non-current assets. These fixed assets also relate to furniture and various assets and various appliances and various equipment which the company is using for her business. Tangible assets and fixed assets are more or less similar, with a slight difference between them. Then the total of non-current assets, which is totaling the fixed assets and the tangible and intangible assets, comes to 10,626. Current assets are something which is liquid cash, or assets which are easily encashable into liquid form, which is there with the company. Current investments could be in any mode, 2,369 in the latest year. Inventories, the medicine that is normally produced by the company, they have to keep a stock of those medicines so they can supply regularly to various vendors. And this also has to be in a reasonable volume, because the turnover has to keep churning itself. 3,500 crores, whereas it has ranged from 2,500 to 3,500 in the past 4-5 years. Trade receivables from sundry debtors, 5,000 crores. Cash and cash equivalents in the bank, which is about 205 crores. And there are other current assets which may also be encashable, miscellaneous forms ranging from 1,100 to 1,491. These current assets are totaling to 12,599. More or less, you can say that 12,599 is something that the company has got encashable assets, you see. And this, when combined with non-current assets, gives you a total of 23,225. This has to match with the liabilities, which is also 23,225. However, in these liabilities, apart from actual liabilities which the company has to probably give or pay or return, you also have shareholders funds added to it, because shareholders fund is also considered as part of the liability. However, in case for your information, if the company has to uh, encash its uh, assets in any form, whether it is fixed asset, non-current assets, or current assets, and from those, if the liabilities are removed, the balance will always be shareholders fund, which is belonging to the corpus of all the shareholders. Other information is also given in the balance sheet, which is also of sometimes of interest to the shareholders. Contingent liabilities, which could be liabilities from various sources, which is there claiming upon the company. And for a Dr. Reddy with a high turnover and a company of such repute and one of the leading pharma companies, 500 crores to 1,000 crores of contingent liabilities will always be there. It is considered to be a norm. Bonus equity share capital, this indicates that out of 83 crores, which you see the equity capital on top, 83 crores, the bonus element has been 56 crores. That means over the past so many years that Dr. Reddy has been in the stock market, they have probably started off with say 27 crores of equity capital, maybe initially. And then on that, bonuses has been given. Bonus means when free shares are issued to the shareholders, and it capitalizes the shareholders' reserves and transfers the amount from shareholders' reserves to the equity capital of the company. And the shareholders are rewarded with free shares, increases their number of shareholdings. So that has probably increased twice over 27 nearly, you see. So uh, 27 plus 56 makes it 83 crores. That means in past so many years, the details of which will be probably given elsewhere in an AGM report, company on every one share has given 2 shares of bonus over so many years. That means anyone who must have purchased 1 share of Dr. Reddy initially may be holding 3 shares today. 100 shares will become 300 shares. The face value of Dr. Reddy has been rupees 5 on this equity capital for your information. Then we have non-current investments and the current investments, which are also part of the balance sheet. And this is how we study this balance sheet over the last 4-5 years. We see the trend over the last 4-5 years. We see that the borrowings are not very high. The debt equity ratio is within limits. The tangible assets, intangible assets, and the current assets are also good enough. Current assets, when it is divided by liabilities, gives you the current ratio, which also in the ratios we had discussed. From the current assets, sometimes inventories are removed, which are sometimes not easily encashable. So the remaining current assets, when divided by liabilities, gives you quick ratio. See, these ratios also we had studied in the previous episode, and when you combine the ratios with the balance sheet, you will be able to gauge the strengths, the weaknesses, the company's uh, growth on business over the years, and will give you a good perspective and a good picture. So let us come to the next company. This is a leader in the IT field, information technology, as we all know, Infosys Limited. Infosys has today on 31st March 2020 a share capital of 2,122 crores. It has been fluctuating from 2,170 to 122 in between, because in between the company had purchased shares from the market, as we call it, buyback of shares from the market. Sometimes when the share price falls too low and the company feels that the share price is below the intrinsic value, they offer to the shareholders a higher price and they purchase some shares, as it is allowed by SEBI also. And the shareholders also benefits. The company's floating stock also reduces. The company's shares eventually will probably be listed at a higher price. The market price will become higher. And this is how little bit of a fluctuation in share capital takes place. In between, Infosys in year ending 2019, 31st March, had given a bonus between 18 and 19, 1:1. For every 1 share, they gave 1 share as bonus. We will see the bonus element later on again. The total share capital you can see. Then we see the reserves and surplus, which is again a very, very substantial figure. With 2,000 crores of equity capital, Infosys has got a reserve of 63,000 crores. That's nearly 31 times the share capital. Then we come to the liability side, the remaining liability side, so to speak. The borrowings you see, Infosys has got zero all along, long term, even short term also. This is one of the rare companies where the debt equity ratio is zero, flat zero. There is absolutely no borrowing that this company does. Whatever cash it generates, it uses that for the business, and it does not need to pay any interest because there is no loan whatsoever. Then you have deferred tax liabilities, other long-term liabilities, and long-term provision, of course, is nil. Then the total non-current liabilities have been shown here, and the current liabilities are considering of trade payables, which they have to pay to sundry creditors. Other current liabilities also there, which they may have to pay to many people, many other agencies, many other vendors. Short-term provision is also mentioned here, and you can see the total current liabilities is coming to a total of between 13,000 to 20,856 crores. This, when combined with the total shareholders fund, becomes the total liability of 92,768 crores. Now, assets also will have to match this 92,768 crores, and that is how what is called balance sheet, balancing each aspect, you see. So we see the non-current assets, in which tangible assets are 16,000 crores. From 8,000 it has increased in the last 4-5 years. Intangible assets have also increased from 985 to 1,900. Capital work in progress is already there, going on continually for the company's growth in all over the world. Globally, it has got offices all over. It is always wooing business from all classes. So the fixed assets totals 19,457, and this with non-current investments, deferred tax assets, long-term loans and advances which the company may have given to some agencies, other non-current assets, totals the non-current assets to 38,192. Current assets will be the difference between 92,000 and 38,000, which is around 64,000. As you can see here, 54,000. This totals with this and brings 92,768, the same as liabilities. And what is there in current assets? You can see the current investments with the company, probably in the field of information technology. So much of equipment is there, so many other investments in terms of trying to buy businesses there is always continual. That is how the company's growth is always registered. Inventories are nil because in information technology, there need not be any inventory of any produce as such. It doesn't have any manufactured goods, see? So there is no question of any inventories. Trade receivables from the sundry debtors, so much of money will come from them. Cash and cash equivalents. This is a very important part in this particular company, as you can see that it is always a very cash-rich company. From 32,000 crores in 2016, it is maintaining 5 figures all along. And why did it reduce from 32 to 22 to 19 to 18,649? Because Infosys has been using its cash reserves for purchase of many other smaller companies, many other agencies, which is very instrumental to the growth of their business. And that is how they keep declaring, keep taking shareholders' approval also. And the company keeps growing in that manner. And that is how information technology companies, they grow. Still, after acquiring them, it is sitting on a cash of 18,649 crores. That gives an ample leverage to the management for scouting around and seeing that if there are any companies in the world, globally, anywhere, which is worth buying, worth accumulating so that the business grows exponentially, they are able to do that within this cash equivalent. However, if they want more, they can always have many other resources to borrow money. But Infosys has so far not resorted to that kind of arrangement. It has always managed things with its own available cash. So the total current assets comes to 54,576, which totals with the non-current assets and gives you a total of 92,768. Then you have the contingent liabilities column and the bonus equity share capital. This is something remarkable. You can see 2118 out of how much? 2122. That means probably Infosys has started initially in 1990s with a capital of only 4 crores. And that 4 crores over the years, nearly 30 years, has been growing with umpteen number of bonuses, which Infosys has definitely given to the shareholders, and it has grown to 2100 crores. That is why it is very well known that even a driver of a director in Infosys probably is a millionaire today, you see. And many shareholders have become multi-millionaires because Infosys has not only given very handsome bonuses, it has kept on growing. The share price also has kept on growing, and with the good market capitalization and good capital appreciation, it has very handsomely rewarded the shareholders. Not to speak of the dividend, which these IT companies normally give a large part of the earnings. The dividend payout ratio comes to nearly 50% to 60%, whereas many other companies have 25% to 30%. And despite such large rewards as dividend and bonuses, Infosys has accumulated 63,000 crores as reserves with the 2,122 crores of share capital. That is something really remarkable how the company has grown and how it has rewarded the shareholders. And this is why the market also has given a very thumping appreciation, and uh, Infosys share price commands a very high respect in the market. So this is what the balance sheet of Infosys has shown, friends. And if you will check the balance sheets of other information technology companies, it will give you a better perspective, a clear perspective. And with this, you can compare um, many companies in a similar manner, which is available in different websites, and get a very clear picture in your mind. And this will acclimatize you in understanding and deciphering a balance sheet that much more easily. Let's come to our third company now. This is a market leader in a fast moving consumer good, as we call it, FMCG sector, Britannia Industries Limited. They are a confectionery company. Biscuits are very famous, as you all know, and they make so many other products of dairy, milk and cheese and bread and whatnot. So Britannia Industries I have chosen because it's a very prominently known company. The products are very prominently known by you and me. We all consume it also, more or less. And you see in the balance sheet here, the equity share capital is 24 crores. It has been for the past 5 years, more or less same. Reserves and surplus are still quite substantial, 4,344 crores. So the total shareholders fund becomes 4,402 crores. And you can see from 2016 31st March, this has grown, nearly doubled. From 2091, it has become 4,400 crores. In 4 years, it has doubled, more than doubled actually. This would mean 18% per annum compounded. Roughly 18% per annum compounded has been the increment in shareholders fund. It's a very remarkable growth, my friends. You must appreciate that. Then we come to the borrowings. Long-term borrowings has been quite meager. In fact, only in the year ending 31st March 2020, of course, the 31st March 2020 ending, many companies had to resort to loans because of the economic growth not really growing that much. Uh, and also with the COVID just starting, as we all know, the funds that were necessary for working capital and for equipments and machinery and for many other reasons was something that were needed by the companies. So they have taken this loan. We will see probably in the next balance sheet, we will come to know how much of this loan has been reduced, whether it has been reduced or not. Short-term borrowings also has been meager all along, as you can see. In the year 31st March 2020, it has gone up substantially to 748 crores. Trade payables are more or less quite similar, from 769 to 1100 crores. Other current liabilities are also in the reasonable limits. Short-term provisions are being given all along from 175 to 191. Total liabilities, you can see, it ranges from 1300 to 2500 crores. And the liabilities, when we add with the shareholders fund, gives you total capital and liabilities, which is ranging from 3500 to 7800 crores. Again, doubling up, coming up to nearly 18 to 18.5% compounded per annum. So now the assets also has to match this 7842, as you see, 7842.23 here. And the breakup is as follows. Tangible assets, you can see from 821, it has come to 1731. Naturally, when the company grows, that much more fixed assets or assets which are necessary for the running of the company's business is necessary. Intangible assets are very few, very less, and it is the company has not shown much figures over there. Capital work in progress has ranged from 90, went up to 200 crores, and it's 40 crores at the end of the 2020 31st March. Then you have fixed assets, non-current assets, long-term loans and advances, and other non-current assets, which totaled up to 4167. Now, difference of 7842 total liabilities and total non-current assets becomes current assets. So you can see current assets now, current investments which the company has made in different fields, inventories, the produce of the company has to be kept in some measure so that it can be distributed at the demand of the various vendors. Trade receivables, 320 crores, which is rather a figure which is more or less growing in a acceptable manner. Cash and cash equivalents, about 100 crores average cash company has been, more than 100 crores has been maintaining all along. Short-term loans and advances which the company has probably given to some agencies. Other current assets are also reasonable, and the total current asset becomes 3675. In fact, the entire total current assets, I would say, are quite encashable, liquid cash, and for the calculation of quick ratio, normally inventories are removed. Otherwise, inventory for a fast-moving consumer good company is normally considered to be quite encashable. So total assets are matching 7,842.23. Contingent liabilities are also reasonable, ranging from 300 to 277 crores. You see bonus equity share capital, again, such a lovely company. 24 crores of equity we have seen here, and out of that, 21.94 is the equity bonus. That means the company may have started off with 2.06 crores so many decades ago, and that 2.06 has multiplied by way of bonuses to 24 crores today, 12 times nearly. And that's substantial because earlier, if you recall, the face value was 10 rupees, and today the face value is 1 rupee. In fact, it was 2 rupees till 31st March 2018, and then it was split from 2019 onwards, and it has become 1 rupee. That means 10 times the share has been split and given to shareholders, plus 12 times the free bonuses have been distributed. I'm sure the shareholders must have really reaped a good reward from this company. Today, at this stage, if I remember now, Britannia Industries, a 1 rupee face value share is more or less 3,800 rupees costing in the market. 3,800 times the face value. You see, so the balance sheet of this company is very strong, very good, and very good growing company. And this is what you have to understand. This is what you have to decipher, and this is what you will have to uh, make a clear perspective in your mind by comparing various companies. And this kind of a acclimatization, this kind of a practice, this kind of a getting to know them so very easily is something that you will, all of you will have to do on your own in your own spare time, and it will give you a very clear picture of any company. So friends, I'm sure you must have enjoyed the balance sheets explained. Now, you must also search through all available resources and study the balance sheet of many other companies that you may be interested in. that will accustom you with a good perspective of such figures to understand. Be familiarized with them readily. A good understanding will allow you that much easily to be able to identify a good quality company. Because do remember, friends, when your hard-earned money is at stake, you, and I repeat, only you have to decide which business venture to embark upon. And reminding you yet again, get into a business only by purchasing the equity shares. Sit back, enjoy, watch, and with due patience, reap the benefits. And all that without creating any other infrastructure. Isn't it a wonderful way of investing your money? Isn't this business worth embarking upon? I'm sure, friends, you will have the right answer. In our next discussion, I shall explain the analysis of the profit and loss account of few companies. That will more or less complete the fundamental analysis of our explanations. Till then, let me remind you to ensure subscribe to this channel in case you have not done so far, and that will provide you with all the earlier and future episodes easily on your screen in good time. Do post your comments and queries, if any, to which I shall indeed reply. Friends, see you again soon and have a nice day.